Here's something that might shock you. While everyone's panicking about falling property values, the smartest investors are quietly preparing for the biggest wealth-building opportunity of the decade. Today, we're going to uncover why a housing market crash isn't the disaster most people think it is, and how you can position yourself to benefit massively when others are running scared. Welcome back to the channel. Today, we're diving deep into one of the most misunderstood topics in real estate investing: housing market crashes. When property values drop, homeowners panic, buyers freeze, and the media fills with doom and gloom. But here's the truth: market downturns create the most significant investment opportunities for those who understand how to navigate them. In this video, we'll explore why housing market crashes aren't just survivable, they're actually wealth-building gold mines for prepared investors. We'll break down the psychology behind market fear, reveal proven strategies for capitalizing on distressed properties, and show you exactly how to turn economic uncertainty into financial opportunity. Whether you're a seasoned investor or someone just starting to think about real estate, this discussion will change how you view market volatility forever. We'll cover everything from identifying undervalued properties to timing your market entry perfectly. Let's start by acknowledging the very real challenges that housing market crashes create. When property values decline, homeowners watch their biggest asset lose value, sometimes dramatically. Families who bought at market peaks suddenly find themselves underwater on their mortgages, owing more than their homes are worth. For potential buyers, the situation seems equally daunting. Even though prices are falling, securing financing becomes more difficult as lenders tighten their requirements. Credit standards rise, down payment requirements increase, and approval processes become more stringent. This creates a perfect storm where fewer people can qualify for mortgages, even when homes are more affordable. The ripple effects extend beyond individual homeowners. Construction companies slow down new building projects, real estate agents see commission income drop, and entire communities can feel the economic impact. Local governments face reduced property tax revenues, affecting public services and infrastructure investments. But here's where most people get it wrong. They focus only on the immediate pain without seeing the bigger picture. Market crashes are cyclical events that have happened repeatedly throughout history. Each time, they create temporary dislocations that smart investors can exploit. Think of it like shopping during a major sale. When a department store needs to clear inventory, they mark everything down dramatically. The same clothes that were expensive last month are now affordable. The housing market works similarly. Economic pressures force sellers to reduce prices, creating opportunities for buyers with cash and financing. The key insight is understanding that real estate is a long-term investment. Short-term volatility creates temporary pricing inefficiencies, but underlying property values tend to recover and grow over time. This is especially true in desirable locations with strong fundamentals like job growth, population increases, and limited land availability. Now let's explore how market downturns create unique investment opportunities. The most fundamental strategy is buying low-acquiring properties at significantly discounted prices when sellers are motivated and competition is reduced. Strategy 1. Distressed property acquisition. During market crashes, distressed properties become abundant. These include foreclosures, short sales, and properties owned by sellers facing financial hardship. Banks and financial institutions also accumulate real estate-owned properties that they're eager to sell quickly. Here's a simple example. Imagine a 3-bedroom house that sold for $100,000 before the crash. During the downturn, similar properties might sell for $70,000. That's a 30% discount on the same asset in the same neighborhood. The key is identifying properties with strong underlying value despite temporary market conditions. Look for homes in good neighborhoods with solid infrastructure, schools, and employment opportunities. These areas tend to recover fastest when markets stabilize. Strategy 2. Fix and flip opportunities. Market crashes create ideal conditions for fix and flip investments. Lower property acquisition costs combined with reduced competition from other investors mean better profit margins on renovation projects. Consider this scenario. You purchase a property needing cosmetic updates for $60,000. After investing $20,000 in improvements, you have $80,000 invested. When the market recovers, that same property might sell for $110,000, generating a $30,000 profit. The beauty of this strategy during downturns is that renovation costs often decrease too. Contractors and suppliers may offer better prices due to reduced demand, further improving your investment returns. Strategy 3. Rental property development. Falling purchase prices create opportunities to build rental property portfolios. When you can acquire properties at below market prices, the rental yields improve dramatically. Here's how the math works. If you purchase a rental property for $80,000 that generates $1,200 monthly rent, your annual rental yield is 18%. The same property purchased for $100,000 would only yield 14% annually. Lower acquisition costs mean stronger cash flow and faster payback periods. This allows investors to build larger portfolios more quickly, creating multiple income streams and long-term wealth accumulation. Strategy 4. Market timing advantages. Housing market crashes don't happen overnight. They typically develop over months or years. This gives informed investors time to position themselves strategically. By studying market indicators and economic trends, you can identify optimal entry points. The secret is understanding market cycles. Housing markets move in predictable patterns: expansion, peak, contraction, and recovery. Most investors only pay attention during expansion and peak phases when prices are high and competition is intense. Smart investors focus on contraction and early recovery phases when opportunities are abundant. Strategy 5. Financing opportunities. While lending standards tighten during market downturns, opportunities still exist for qualified investors. Government programs often emerge to stabilize markets, sometimes offering favorable terms for investors who can help revitalize neighborhoods. Private lending markets also become more active during crashes. Individuals and institutions with cash seek higher returns than traditional investments provide. This creates opportunities for creative financing arrangements that might not exist during stable markets. Strategy 6. Portfolio diversification. Market crashes provide opportunities to diversify real estate portfolios geographically and by property type. Different markets crash at different times and recover at different rates. Investing across multiple markets reduces risk and increases potential returns. For example, urban markets might crash first due to job losses, while suburban markets remain stable longer. By understanding these patterns, investors can allocate capital strategically across different market types and locations. Strategy 7. Long-term wealth building. The most powerful aspect of crash investing is the long-term wealth creation potential. Properties acquired during market lows typically appreciate significantly during recovery phases. This creates substantial equity gains that can fund future investments. Think of it as compound growth acceleration. Every dollar invested during a crash potentially generates higher returns than the same dollar invested during stable markets. Over decades, this compounding effect creates massive wealth differences. Let me share a compelling example that illustrates the power of crash investing. During the major housing market correction of the late 2000s, while most investors were panicking and selling, one investor took a completely different approach. This investor had been studying market cycles and preparing for the inevitable downturn. When prices began falling, instead of retreating, they went on a buying spree. They focused on quality properties in desirable neighborhoods that were selling at steep discounts. Over 18 months, they acquired 12 properties at an average price that was 40% below pre-crash values. Each property required some renovation work, but nothing structural or extremely costly. The total investment was approximately $800,000 for properties that had previously been worth over $1.3 million. The key insight was recognizing that the fundamentals of these neighborhoods hadn't changed. The schools were still good, the locations were still convenient, and the communities were still desirable. Only the prices had changed due to market psychology and financing challenges. During the recovery phase, something remarkable happened. Not only did these properties return to their pre-crash values, but they continued appreciating as the market overshot in the opposite direction. Within 5 years, the portfolio was worth over $1.8 million. But the story doesn't end there. The rental income from these properties provided substantial cash flow throughout the recovery period. The investor was able to refinance several properties, pulling out cash to invest in additional opportunities while maintaining ownership. This example demonstrates the 3 pillars of successful crash investing: preparation, patience, and strategic thinking. The investor had prepared financially to act when others couldn't. They had the patience to hold through the recovery cycle, and they thought strategically about long-term value rather than short-term volatility. And let's summarize the key insights from today's discussion. Housing market crashes, while challenging for many homeowners, create unprecedented opportunities for prepared investors. First, we explored how market downturns generate distressed property opportunities. Lower prices, motivated sellers, and reduced competition create ideal buying conditions for those with capital and financing access. Second, we examined specific strategies like fix and flip investing, rental property development, and market timing approaches. Each strategy leverages the temporary pricing inefficiencies that crashes create. Third, we discussed how financing opportunities and portfolio diversification strategies can amplify returns during market downturns. Finally, our case study demonstrated how one investor turned market adversity into massive wealth creation through strategic thinking and patient execution. The critical insight is shifting your perspective from fear to opportunity. While others panic about falling prices, successful investors recognize that all real estate markets are cyclical. Crashes are temporary events that create temporary opportunities. Remember, the best time to invest is when others are scared. This contrarian approach requires emotional discipline and financial preparation, but the rewards can be life-changing. The next housing market crash is not a question of if, but when. By understanding these principles and preparing accordingly, you can position yourself to benefit rather than suffer when market volatility returns. Start preparing now by building your financial reserves, studying market indicators, and developing relationships with lenders and real estate professionals. When the next opportunity arrives, you'll be ready to act while others are paralyzed by fear. What's your take on housing market crashes? Do you see them as opportunities or threats? Drop your thoughts in the comments below. I read every single one and often respond personally. If you found this content valuable, smash that like button and subscribe for more real estate investing insights. Hit the notification bell so you never miss our latest videos on building wealth through property investment. Ready to dive deeper into protecting yourself? Check out this video. Can you recession-proof your life? Until next time, keep building your wealth and remember, the best opportunities often hide behind market fear.